So the venture capital game is a very different game in the sense that you are expecting most of your returns to come from one or two bets in the fund, for example, and you're expecting 80-90% of the fund a lot of those investments may go by the wayside or may not do much long term. So basically, it's a very different game. I think it's very hard to get downside protection in the venture game. And I think it's very hard to do these future cash flow projections and all of that because we just don't have the trademarks. We don't have the historical trademarks. So it's not something that I think I have expertise in. The other thing about the venture business is that if we look at the statistics, so in Silicon Valley, which has had a very long history of venture capital, the venture funds that have, let's say, the top 10%, their annualized returns are in the top 10% of venture funds. Their returns are multiples of, so the top quartile funds have done much, much better than the bottom quartile funds. And if we do the same thing with bond funds, for example, the difference between a top quartile bond fund and a bottom quartile bond fund may be almost non-existent. Might be like 100 basis points or 200 basis points. It would be a very, very small difference. So what I'm saying is that the ability to add alpha in a bond fund is very limited. And if we look at a fund like Sequoia Fund or Andreessen Horowitz or Y Combinator, etc., they have an advantage. They have multiple advantages, but one of the big advantages they have is deal flow. So I have some friends and some of my investors are venture capitalists in Silicon Valley. They say to me that if we had access to the trash can of Sequoia, our returns would be 3x what they are. So he said if we could just look at every deal that Sequoia turned down, we would do 3x better because they said we just don't get to see. So deal flow. So one of the things about the public markets is the small